All right. Welcome, everyone. Today, we're going to talk a little bit about DeFi and really how it's been resilient in times of turmoil in the broader crypto market, especially recently as exemplified by kind of the blow up and struggle of some large CeFi players. So really excited to bring a pretty diverse group of panelists across the DeFi ecosystem: Matthew Rozak, Mika Honkasalo, and Graham Nelson. Really, what we kind of want to talk about today is three things. First, kind of views on where we are in crypto in this market cycle, and more specifically, kind of how the operators and investors participating are positioning themselves. Then we're going to kind of move on to talking about where the space is going in the future, focusing on the specific use cases that are potentially going to kind of dominate in the coming few months and years. And then kind of stepping back a little bit, thinking a little bit about what we can do in the DeFi space to make it safer, make it more secure, but also just make it more usable. Make it more usable for institutions, whether that's from a regulatory perspective and a transparency perspective, but also for kind of general purpose users and the longer tail of people coming into the ecosystem. So quickly before we actually dive in, I just kind of want to introduce our panelists and give the audience a little bit of background. So Matthew's the co-founder and chairman of Bloq and co-founder of Vesper Finance. He's been investing in crypto companies for about almost a decade now. And particularly, we're really excited to talk about Vesper, which is a platform for easy-to-use DeFi products. Next, we have Graham Nelson, who's a product manager at Aave. His previous experience was focused on building custody solutions and DeFi integrations of regulated institutions in South Africa and Switzerland for around 5 years. And last, we have Mika, who was formerly at the Bloq and then Verify Capital, and is now an independent researcher in the DeFi ecosystem, is very active in governance across a number of protocols we're going to talk about today, and has generally been someone I have gone to, whether it's on Twitter or just in kind of looking at Substack for kind of coverage and analysis on the turmoil we've seen over the past couple months. So really excited to have you three on today. All right. So I guess to kick it off, talking a little bit about the current state of crypto and DeFi, I would love to start with you, Matthew, and just from your perspective as a operator, particularly a crypto infrastructure and application operator and investor. Does this recent market correction change how you think about the crypto space in the near, medium, long term? What are your thoughts?
Thanks, George. And I think you started off the right way where you mentioned DeFi resiliency. And I've been using this analogy for a while. We're in a crypto winter. And the way we got here was the good, the bad, and the ugly. I used to say Tale of Two Cities, Charles Dickens, but this most recent three past months has been the good, the bad, and the ugly. The ugly being Luna, right? And not having that platform be pressure tested was important for this industry, and then that cascading into the ugly, the bad, which is CeFi showing itself on its risk management and a variety of other things that seeing those wheels fall off in CeFi participating in this industry. But the good is DeFi. The truly well-engineered products in this space, the things that were engineered well, continue to meter and clock and run and gun as intended, and that was refreshing to see. and you didn't have to go into a CFI investment or credit committee. You had smart contracts doing all that work for you. So no lawyers, no code. Sorry, no lawyers, no bankruptcy, no all this kind of legacy stuff in DeFi. It's all self-adjudicating, and the smart contracts are law, and it's that was cool to see. That all being said, a lot of people lost money in Luna, being in a crypto winter, and seeing, quite frankly, even in the Wall Street Journal, misinformation about DeFi being, dead or what have you. I think DeFi has thrived through this last ecosystem, and it's good to see these. Just like in nature, you want to see some cleansing, and in tech cycles, that's what happens. We're going to see a lot of cleansing this space. So I think it's important. Where we are all looking to build trillion-dollar networks, and so when you see a hack, when you see a Luna, when you see some of these things that, to the untrained eye, look like a calamity, to the long-term kind of view of this, is a part of the journey. And kind of looking back 10 years from now, we'll look at this as kind of rounding error, albeit it's still very real and rough and kind of raw, given the last 8-12 weeks of what's happened. But from a builder investor standpoint, I think DeFi is obviously here to stay. Is only going to grow from here.
Makes a lot of sense, and kind of one of my favorite memes about bear markets is, that's when builders come out, and Graham, you would be kind of the perfect example of that. Especially coming from your seat, at Aave, you've definitely had experience navigating a lot of tough times in crypto as a protocol. What advice do you have for developers who are experiencing, maybe it's their first bear market?
Yeah, and I think, it's a good question. I think Matthew also touched on it as well. I think, the bear market's a great time for builders to build. It also takes a lot of heat and pressure on. In a bull market, it's all about like shipping, and we can see the consequence of shipping too quickly in the bull market. And I think the bear market just allows builders to come in and put their head down and ship solid, good code. And also learn from the mistakes of the past and continue building. I think it's a great time. I think we saw in the previous winter, if you want to call it, the great protocols that came out of that in the DeFi space. And I think we'll see the same thing coming out of the current winter, a whole bunch of builders developing new or current DeFi protocols, also continuing building and adding new functionality and new products and services around that. So I think it's always an exciting time to see what happens now in the bear market while the builders. And I also feel like just stick around, like have the conviction, the space is here to stay, to grow. It's only going to get bigger, and you really reap the benefits in the long run by building through the bear market.
Makes a lot of sense. And I guess just to kind of follow up or dig deeper, obviously, Aave has had a pretty impressive product development pace. Does that change? Do you recalibrate how you think about what products you might want to launch, or what upgrades might be most relevant? Does that change at all in kind of crypto winter?
No, I think we have a really strong conviction on the Web3 space, and the market conditions doesn't change that. The strategy, the vision of the company stays the same across all our products, and that's what we're working towards. So be it a bull market or a bear market, it doesn't really impact our decision on the products that we're looking at building and contributing towards. So right now, the answer is no, nothing changes for us. It's we keep building, we keep shipping product.
And Mika, I think something that Graham said earlier was really interesting around how so many of the currently leading DeFi protocols were kind of built in a down cycle. So as someone who has been exposed and has covered many of these protocols, what do you see as common threads among those that have survived and really thrived in bear markets, and for those out there that are, thinking of using this time to build, what is what are some of those common threads between sustainable models?
It's funny that I think if you look at the current batch of the protocols by whatever metric you want, but the simplest one, just the value locked in them, how many of them just are the same ones that were already existing and started off really the DeFi summer in 2020, and they haven't really been replaced. And if you take a look at that list and just look at what protocols are new ones there, it's actually the kind of the ones that are something new and different, like Lido with liquid staking that didn't exist at the time. So the really like new sustainable ones tend to be ones that are actually like novel and bring something new. Whereas if you're just doing like a fork or a copy and trying to do something around that, that doesn't seem to be working that well. And it seems to be like actually a lot of the really like original DeFi protocols are designed really well for their use case. And so yeah, that you can't really go that route. You really have to be like something different. And I think it actually shows like what a good job a lot of projects like Aave and Uniswap have done, that they've maintained that dominance. But yeah, for sustainability, every sort of naive assumption about sustainability, I think, got killed immediately as sort of the bear market started. And those are things that we sort of knew already, like Luna being the classic example where you knew the failure case, and if you analyze the situation and you understood like how it could go wrong. So basically everything that seemed to have like a case that you can make against it, really, of the financial side breaking down, those things broke down. And it extends even to things like liquidity mining, where a lot of the protocols, like you grow very quickly, but then you sort of exhaust the tokens you're able to incentivize with, and it puts a lot of downward pressure on the price. And you can actually see like most of the early DeFi protocols do that very little or not at all nowadays, and have built like that mode. So yeah, I would say like sustainability comes from building very like new things, and then not having these naive security assumptions, and actually preparing for like an adversarial environment.
Got it. And kind of in that response, I heard three, distinct metrics, the first TVL, and then, price, and then, some form of yield or, returns you can provide users or liquidity providers. So Matthew and Graham, as operators of DeFi protocols, what metrics do you guys care the most about? Maybe personally, or your communities?
That's a great question. It's something we think about a lot. I think the DeFi community thinks a lot about. I think the common denominator there seems to be TVL, but not all TVL is created equal. It's like, what's the health of the TVL? And I think as we move forward as an industry, we'll see TVL stratified in different ways, meaning time value of that TVL, meaning $1 billion has been sitting there from one particular wallet for a year or something. How many wallets? So I think there's going to be some stratification there on that. And I think everybody wants more users, and kind of get out of this environment where we're tending to kind of the crypto community, if you will, and how do you expand that even further? And we'll probably talk about that a little later. But right now it's TVL. It's like saying revenue cures all. TVL for a lot of DeFi projects cures all, but it's not, like I said, not created equal.
Yeah, and I think Matthew touched on a lot of the point. I think with TVL, it's a really important metric, but I think what we're also learning now is, having a look at the TVL or the majority of the wallets on Ethereum, but then comparing it to what we see on like the Polygon market for Aave, and seeing actually the changes of the metrics there, and where we see more users there, but much lower value in comparison to the Ethereum market, where it's higher value, less users. So it's also interesting comparing and seeing how each market is performing on each chain to also just give you a different metric. It also gives you an idea of who's using what chain, where I think it's like, yeah, so very interesting because each chain is fitting a different use case now.
Got it. And I guess taking a quick step back, we've mentioned Terra and Luna a few times now, like even just in this 15 minutes. For those in the audience just who might not have the full background, I would love, Mika, if you could kind of walk through quickly how the events there unfolded, what we were able to see just looking at transparent DeFi rails, but then also what kind of fallout was among centralized players, and if you think there's additional kind of risk in the system, like has everything been flushed out? Where do we stand kind of as the market has generally been going sideways?
The good part about the DeFi protocols is that they're able to stay like solvent in a sense because they always act senior to all other debt because they're over collateralized and can enforce like repayment. So that's something that it's actually very interesting, like to see the interplay between like the transparent and opaque nature of DeFi versus CeFi and how they interact together, because DeFi actually was like a really good indicator for a lot of things where you started to see like these weird actions like large STEs selling and like these very specific things that were kind of like weird and you knew something was very wrong. So it's very interesting also to see like how non-transparent financial sort of activity acts with transparent one and what the transparent one like gives to it, but also it does give an ability to sort of misuse customer funds always, because the DeFi side only tells really half the story, and still on the CeFi side you can sort of screw things up a lot, even if you're over collateralizing those specific positions. But yeah, from the Luna side, it started like with a very, very clear thing where the stablecoin was unbacked or was backed by Luna tokens. If those Luna tokens are perceived to be not valuable, that means there's no backing and everything goes to zero. It's like a very clear scenario under which like a bank run happens. It seems like a lot of the leverage has been like flushed out of the system for now, and especially if you look on chain, there's basically no leverage like left at all at the current moment. So it's probably like quite like the DeFi side is quite reflective of like the CeFi side in that sense, even if it doesn't give the full picture. So yeah, I would say like that now it's just it's like a reset completely, and well, the good part is that lots of these protocols are like Aave are a lot more trustworthy now. They've been like through a lot more than they were a couple of years ago, and they're also a lot larger. Like the liquidity mining at DeFi Summer, it did actually sort of work, honestly, because like these protocols are like 10 to 100 times bigger in a couple of years. So growth has really happened, but sort of where the next batch of growth comes from, it doesn't come from token incentives, that sort of thing. That's where we're like positioned right now, where it's I think it's quite unclear.
It's an interesting point because I think everyone in this chat is kind of in violent agreement that DeFi rails have held up better. They've been more transparent. But one thing we saw kind of in the big bull run was a lot of new users being onboarded through some of these shiny fintech wrappers, that were these CeFi companies that were basically just parking that money in different DeFi protocols and trying to get yield through DeFi. That obviously represented a lot amount of capital kind of flowing into the space. And how does the group kind of feel about where kind of that next group is going to come from? Are people going to trust some of these platforms that are promising high yield? Are they going to trust DeFi? Like how do we kind of like make what can be done to kind of bring in everyday users who might have been burned in the past?
Yeah, I mean, as an industry, we've got a lot of work to do in terms of maybe best practices, which when the bar raises, everybody will raise up to it, I think, in terms of, how you do audits and the transparency and all that. So I think there's going to be a lot of kind of self-regulation and kind of create our own best practices before we get any external factors from that. But then thinking about, who are the users in DeFi, and what are the concentric circles of users today? And it's like the kind of the middle ring is the DeFi degenerates, the degens that we know and love, which is a term of love because these are real money tests in these new protocols, and there's a high risk, high reward. So degens, are an important piece of this equation. And then you have, crypto community, crypto funds, which have institutional capital as LPs. And then going beyond that, that's kind of the frontier that I think everybody in DeFi is thinking about in the back of their minds. And then more matter of factly, I think this notion of bridging between what DeFi is defined as today, user base, and where it needs to go, which it needs to attract institutional capital. And I think there's the next ring I think will be B to B to C. So a lot of DeFi will enable a lot of brands and platforms, whether that's an FTX or Coinbase or Schwab or pick your favorite platform that has users that are not going to let's be honest, not going to download MetaMask and kind of do that anytime soon for a certain group of asset holders, but needs to be kind of plugged in. So at Vesper, we're developing this strategy called HYFI, HYFI. So it's hybrid finance. And this interstitial space between DeFi and traditional finance needs to get captured in a particular way. And I think the biggest hurdle there is clearly regulatory dynamics for grandma, your neighbor, hairdresser to kind of participate in these protocols. But I think, beyond that, I think a lot of the usability, a lot of the transparency audit, kind of the housekeeping stuff, has gotten pressure tested over the last, 3-4 months. That's all got to improve. And I think that's where this industry is going. But there's going to be this, the way I'm thinking what the whiteboard would look like is you have these permissionless DeFi, and then you have permission DeFi. That institutions will, think about photocopying these different pools and primitives and ideas and create a table of known parties, KYC AML'd, and really start to develop that with the same logic and the same dynamics that is in DeFi. Maybe the collateralization is a little different, but where these two, this fork, how it converges over time, that's the big question in my mind. But I do see two worlds developing in front of us at this moment.
I want to touch just maybe, like in institutional space, in the 2018 bear market, like the institutions sort of were saying, look, we were right, it is a bubble, and the bubble burst. And there was this like opinion about the space then. And now we're in this bear market, and the institutions are now just trying to figure out how they enter in this space in the long run and planning out how they start to get involved. And, we've seen the change in the conversation. And like what Matthew mentioned is like this permission to permissionless DeFi, these two items on the whiteboard. And it's one of the things that like we've tried to look at with Aave Arc, which is like the permission version of the permissionless protocol, where institutions have this like whitelisted environment with KYC participants, and how we can grow that market as well to bring in some institutional capital. And I think that's sort of what we need in the space. I think you want these institutions to come in and get into the permissioned space potentially, and then later on they'll evolve to the permissionless space. There's the famous analogy of these banks or big corporates started with the intranet. Then they realized that the internet was really limiting, and they couldn't do things outside their own internal internet, and that's why they needed to move to the internet. And I think we'll see that progression. We're still a few years away. It's still going to take a bit of time, but I think it's really about focusing on how we get there and self-regulating and getting to the point that when these institutions are ready to move to permissionless or move into the DeFi space, that the infrastructure and the rails have been built to make it really easy for them to do so.
Graham, just to quickly follow up on that, I know, one of the big hurdles for institutions is kind of knowing their counterparty. What is the roadmap? What needs to exist for institutions to actually exist kind of, in the permissionless world and not just in the permissioned world?
Yeah, it's a really good question, and like previously before Aave, my previous company. It was also like a really big question that we always had to answer towards like the regulator, and it's really difficult to answer. I think there needs to be some regulatory oversight in terms of how they see these counterparties in a way. I think it's maybe going to be one of the biggest challenges from an AML point of view as we look at how we prove these counterparties and institutions. And I think that's why something like Aave is a great first step for these institutions, because in these pools, they know the KYC participants, they know that the one whitelist has KYC'd, and if there needs to be a figure out of source of funds, you know that the institution where you can go to and get this information. I think that's where we'd start. And I think from there, the space will grow into a way how we can answer it on a bigger scale. But yeah, I think it's a hard question to answer because I don't think it's been fully solved yet in the permissionless DeFi space.
Yeah, and where regulation comes in is in multiple ways. It's on tokens as security offerings. It's on enforcement of fraud. One area we've seen a lot of chatter on is stable coins. And that's definitely particularly relevant to kind of the fallout around Terra and Luna. Mika, I know you're quite involved in Maker. I'm just curious, to hear your thoughts on, what stablecoin models you see gaining adoption, and kind of how you map that to kind of product market fit within DeFi.
Right now, stable coins are used for, and lending markets more generally are just used for leverage. So the main activity is still highly speculative, and you can sort of see that in the decentralized stablecoin supply, how much of DAI has been minted, especially via crypto collateral, has come down quite a bit. Right now, it looks like the only sort of sustainable model for stablecoins is to have it over collateralized via some way. But there's a lot of room to work on there on what exactly that means, where you can have more different kinds of financial instruments than just having ETH down as the backing thing, but also things like delta neutral positions. Once you have more sort of infrastructure around derivatives, for example, that can make those products more capital efficient, basically, and bring the collateralization closer to one. Which is the best you can probably do. So yeah, from the stablecoin side, it's going to be quite a bit of work to really bring outside assets in, but you can see the first steps already happening there. I think with Maker trying to earn a yield on the USD that's essentially on its balance sheet via US Treasuries, then small banks starting to take out DAI loans. So you are taking those baby steps here on bringing a collateral base, more just from pure crypto collateral into other things. So I think it will be this case where you start off with the basic crypto collateral, and as they become more valuable, you can also expand your base by that way, but also you slowly start to eat sort of at everything else, and you build more advanced financial products also in DeFi, which can be used as collateral. So you start to have this lots of layers of collateral over time, and that's how the stable coins have an opportunity to scale.
So in your view, do you expect to see more fragmentation across, let's just focus on kind of the decentralized stablecoin landscape, more fragmentation there, or are kind of market leaders going to solidify and maybe expand use cases?
I would expect more fragmentation in the short term, because stablecoins are obviously the one if there is one use case you'd have to pick out right now that's working on blockchains and that's sort of semi-popular, you just have to look at the graph of USDC going up, and that's sort of your North Star on what this thing is useful for, at least at the moment. So that's a huge market, and I'm honestly surprised Aave didn't get into some of those ideas earlier. Curve has also announced about those ideas. So it's a very natural fit for if you have a collateral base that is stable, or you have lending activity, to build a stable coin on top of that. And because it's such a big use case, you'd expect a lot of different protocols to try it out. So I think in the short term, you'll actually see a lot of fragmentation simply because like the opportunity is so big to win that use case.
Really interesting. I want to make sure, I'm able to kind of quickly turn to some of the audience questions now that we're at the halfway point. And I'm seeing one from Johan that I think kind of embodies what a lot of people are asking around, how we progress DeFi. And his question is specifically around, how we improve the balance between CeFi and DeFi protocols, specifically frameworks or standards that could be set in place just to ensure, less opportunity for failure, potentially more transparency. I know Matthew, with Vesper, you guys have done a lot of thinking around, audits and other measures that can be taken. How have you approached this, and beyond Vesper, what are your broader thoughts?
Yeah, so Vesper is a DeFi platform to safely and securely generate yield. And I kind of view it as treadmills for your crypto, put your crypto to work. And we were certainly inspired by the DeFi summer, but we're also very frustrated with some of those dynamics that came out of that. Unknown teams, no audits, terrible UI UX, no documentation, all of which makes it hard for any individual to really ape into that, besides these precious degens that helped birth a lot of these protocols. But with all that being said, that inspiration, frustration led to us creating Vesper, where we're a known team. We have over 50 audits. I think the next comparable protocol has like 3 or 4. Full documentation and a UI UX that we really wanted to promote as kind of raising the bar in the industry. And then above and beyond that, thinking through as an industry, not just for Vesper, how we think about yield. Because as we talked about earlier, not all TVL is created equal, not all yield is created equal either. So when you put your ETH, let's assume you want to deposit ETH and earn more ETH. That ETH would go to Maker, create DAI. The DAI would go to Aave, create a yield, go through Uniswap, and back to more ETH. Those are all well-known Lego bricks in the journey of your ETH, and they have a decent wall clock time. They've been around. They've been tested, audited. So it's more of a conservative way to generate yield, as opposed to if any of those Lego bricks were have been around for a few months and they have high yields, higher risk, maybe not audited. And so the striping of the yield and the particular pool, how that yield is generated, I think is another, best practice this industry could benefit from, especially with institutions or newcomers coming in, such that when I do deposit my ETH, I know where it is on the spectrum of risk, because there's some tech risk and other inherent risks in how that yield is generated. So I think that will help advance the dialogue a bunch too.
Makes a lot of sense, and I think something that's related is how users see value in actual tokens as well, and that being a potential room for some transparency. I know famously, certain DeFi tokens, don't, pay protocol revenue out to holders. Curious, Matthew and Graham, how you guys think about, the value of, the tokens that govern your protocols, and maybe even as a follow-up, for users to hold these and for institutions to hold these, what disclosures, what revenue audits, are potentially useful for providing investors.
Yeah, I think a lot of the stuff is on chain, but isn't as readily visually available for most folks. I think some of those, again, standardizing some of the chutes and ladders of how a protocol attracts TVL, generates revenue, and where that revenue goes, I think is a big deal. It's not hard to do. But I think as we were talking about metrics before, how do we create and bubble up a set, like a common denominator set of metrics that gives people like a way to compare stuff. On the token economics, I think lots of folks in DeFi, including most folks on this call, have learned a lot of lessons in token economics, and I still believe that incentives matter, in life and in DeFi and everything else. So incentives are important to attract, liquidity, depositors, customers, all that stuff. How you think about, and I don't want to trample this, Micah, but the sustainability of that, and having participants in your protocol have a voice and also have incentives, and how to marry that up properly. I still think we've got a ways to go as an industry to figure out that balance. I think the tools are there to make that happen, but DeFi summer, we've been doing this for 24 months. It's not a long time. So a lot of lessons have been learned. And I think the smart DeFi builders are going to incorporate those lessons into where this goes.
Yeah, I'll also just say, I think governance hasn't really changed too much over the last 2-3 years. I think since like DeFi summer, if you look at some of the protocols, and I think there's a lot of innovation or thinking around how to look into that as well, which will come up. Because like Matthew says, there needs to be an incentive on the one hand to sort of, promote participation in governance. And I think we'll see a variety of protocols think about how they can sort of set that up to sort of incentivize everyone to participate in governance. Because I think like right now, and I won't speak for like Aave, but if you look at a lot of the protocols, like governance is really difficult. Trying to get engagement and getting people to vote with their tokens is really like a real challenge to get the conversation going and get people getting voting and involved. And I think there needs to be a setup to think how you grow governance participation in the future. And I think it's not easy, but yeah.
Mika, very curious to hear your thoughts as someone who's very active in governance for a few protocols. What have you found as lessons learned, even from like a communication standpoint and kind of gathering support for a proposal or educating communities?
Yeah, I would say the main lesson that anyone runs into when they're participating in those sorts of things is how inefficient it sort of is in like if you just compare to like essentially run a company when you need to get like token holders to agree on something, and it seems like no one really agrees on anything. So my kind of philosophy around that is that only like the things that really need to be governed should be governed, and then you want to automate as much as you possibly humanly ever can to get rid of the human bias there and have like machines take over, and then just like have very, very clear scopes on when the community gets involved and exactly what are the things that can be automated away, or at least on some like timetable you like can progressively move from like centralized decision making into like an algorithmic one. So yeah, I would say that governance minimization, like the goal of governance should be governance minimization in all of these things, and it's still a long ways away because a lot of things have to be tested and tried out before you know how they really work. But I think that's ultimately where the market will go, and that's sort of the promise of crypto, I think, as well, as like these on-chain businesses where the smart contracts do a lot of work for.
Yeah, it's such a great answer. I think the governance minimization piece, I think that's some thinking that is very important now, because again, everybody needs a voice. At the same time, some people just want to set and forget and have the protocol or delegate your vote to somebody. And what does that mean in terms of concentrated delegated votes? Does that kind of tip scales in a particular way? So I agree. We've got a long way to go to figure out the right governance and how that gets pressure tested. So we're not sometimes these are like a homeowners association, and somebody comes out of nowhere with something and just kind of just sucks the oxygen out of the premise and the importance of what was on the table. But again, everybody needs a voice. How those voices are kind of compartmentalized and minimized for effective decision making and building, I think that's the next shoot that we need to go through as a community.
Interesting. One thing I'm seeing from the audience that I think may tie us back into how we're preparing for this space's evolution is around competition in the platform space and the implications of that in DeFi. So actually, it's a colleague of mine, Carlos, is asking, if the group sees consolidation into a single platform or base settlement layer, or more fragmentation towards a multi-chain landscape with larger numbers of app-specific chains, or I would even expand that to even potentially like multiple general purpose L1s that might have slightly different trust assumptions and speed requirements. So how do you guys all see that playing out?
It's a really good question. Keep going.
Yeah, I agree. It's a good question. And I think when we look at it, I mean, the technology space, like when you use, within just a traditional finance space, there's hundreds of different technologies that are being used because at some point in time, they were purpose fit. And these technologies have evolved over time. And I think we'll see the same thing potentially in the crypto space with L1s, L2s, is the space will grow to be purpose fit for the use case. And you might have like Ethereum being the settlement layer, but it might be rolling up into the like Arbitrum or something that is more for speed settlement, right? So lower values and higher value settlement directly onto Ethereum. And I think where we really got to strive towards is taking away this, like extracting the blockchain layer towards the end consumer. You mentioned earlier the grandma, the hairdresser. They don't care if it's Arbitrum or Polygon or Optimism or Cosmos. They're just looking for a certain action or event. They put money in somewhere, they get some kind of return, or they put money, they want to swap one asset to another asset, and they don't care how it's done. Just like they don't care how their website loads today, right? If it's an Angular or React. And so we really need to work there. And I think we're still really on in the technology. So the L1s or L2s that end up being used will still emerge over time, I believe. And I don't think we're at the final state. We're far away from the final state, and that'll come out. And I think you'll move your assets or your applications to the chain that fits your need the most.
Yeah.
And I just add, like you've seen recently with Uniswap, it's been great, right? Their revenue generation on Optimism chain, it's been great. We're seeing that like Uniswap and Optimism is like behaving like an order book now with concentrated liquidity, and it's so cheap to trade there. So and it's generating a ton of revenue. So we're really seeing like now maybe potentially Optimism will be the place for trading for Uniswap going forward, not Ethereum, because it's just so purpose fit for the everyday user. So I think we're going to see more cases of this where certain apps that have lived on Ethereum L1 for a long time will like be way more profitable or way more revenue generating on another chain because it's just way more purpose fit there.
Totally. And another thought flow on this is the way we think about it is these kind of four pillars of tokenization, financialization, coordination, and automation. And just to kind of walk through that, every asset on the planet will be tokenized. And then how do you create liquidity? How do you create leverage? How do you put those tokens and that crypto to work? You have financialization. That's where DeFi comes in. Coordination, we just talked about that on communities and DAOs and voting and governance. That coordination piece is still kind of in the early phase. DeFi is very much still in its early phase. And then ultimately it gets to this automation, and that's AI, machine learning, and kind of decision support for how all this comes together. And that's a ways off. But then you kind of think about the premise of your question. Are these going to be a bunch of primitives? Is there going to be one to rule them all? My sense is the ultimate winner in this space is going to be the best smart wallet. And there's a lot in that, but it's not necessarily that you've got the best lending market or the best trading platform. It's that you got the best UI UX with the smartest kind of ways to efficiently say, where do I get the best yield? Where do I plant my capital to get the best outcome? And have those tools and less clicks hopping from 5 different platforms. And I think that smart wallet, that browser to DeFi and to quite frankly the whole crypto universe is going to be the winner. But there's all the primitives that make that a reality are still in the early phase. So ultimately, that assemblage with proper UI UX, the tech acumen that makes it easier for users is going to be a really big deal. And that's how I see that future kind of coalescing, and kind of the final resting place will be that kind of a smart wallet engagement.
That makes a lot of sense, and I want to dive deeper into kind of what you said at the end around the primitives. And I think it's very reasonable, your prediction around kind of who captures a lot of that value and who might be a winner, but it kind of assumes a lot of primitives around how liquidity does is transacted cross-chain. And Graham, I know Aave, you mentioned Uniswap, but Aave has been, pretty successful in developing, cross-chain, lending pools and whatnot. And, but I think in general, the market, we've still seen a lot of issues with things like bridging. And I think a lot of that infrastructure is still, some of it's a little buggy and some of it's just not built out. So what do you see as kind of the steps of development kind of on that front?
Yeah, I think a really good way of putting it is that like bridges were mainly built in the bull market. And, in the bull market, there's shortcuts and things that are cut out. And I think that's where maybe we've seen today a few of these, you talk about buggy items or vulnerabilities that come up. And I think, again, it's just like bridges is just also really early on as a thought use case. And over time, just like early DeFi, it'll need to go through its learning phase, how to become sustainable, how to be able to resilient. And I think we'll still see, I think we're still really early on in bridging. I think we'll see a lot of different solutions being built now in the current phase. Where we're looking at it from an Aave protocol point of view, I think we see the cross-chain future. I mean, we have Aave deployed on multiple L2s. But with V3, Aave V3 that we launched earlier this year, we're looking at an item called portals, where it allows like our users to be able to deposit collateral on one chain, but be able to then use that and lend assets on another chain. And we see that kind of bridging world playing out. But really to get there, we really need good bridges to be built, and safe and secure bridges where we look at and say, we think they're really secure. And I think there's still a lot of learning that needs to take place in that space and getting understanding. And so we're really early there. And I think that is an interesting space to watch going forward, especially with all these up and coming L2s. So I think it's an interesting space to watch and see it grow and also get strong and more resilient now in the future.
I liked your comment about bridges in the bull market. You got to double check the math there. So yeah, I agree. We have a long way to go on bridging.
Yeah, I mean, the whole kind of multi-L1 thesis really like hit its kind of peak in the bull market. So it kind of makes sense. A lot of that infrastructure, I remember kind of using some of these early bridges and kind of crossing my fingers as, my collateral's like locked on one side, hoping it shows up on the other. But, I know Matthew mentioned earlier from like a user standpoint, what audits do we need to show to kind of give people confidence, whether it's bridging or another layer of kind of that technology stack from like a protocol standpoint? How do you diligence the other, DeFi protocols and parts of the ecosystem that you're integrating with?
It's really hard. I mean, to have somebody, and there's a lot of amazing, walk on water smart contract devs out there. It's hard because you have to learn a completely different discipline, sometimes another language. And so that analysis, that pressure testing, we're still in the super early days of it. It is a big deal to get right, but we've got years to go before the confidence and the flow of value really makes that blood vessel of bridging what we all want it to be. Right now, we've kind of been having a lot of lessons learned over the last 9 months with some of the hacks and everything else. But the magnitude of those hacks and the approach there, it just shows the opportunity and the desire for cross-chain bridging to be a thing. But we've got a long way to go. I mean, and audits sometimes are good on one hand, but when you're entering into a brand new L2 or even L1, again, that's a different language. There's a lot of lessons learned that need to take place before you could confidently kind of move forward. So early days.
Makes sense. And I guess with a little less than 10 minutes left in this, and I want to make sure people have the opportunity to ask more questions, but would love to kind of just go around and hear each one of you kind of talk a little bit about which use cases or which types of projects you think of being very impactful in the next year or so, and what you're excited to see get built.
Just from my standpoint, just quickly, seeing better ways to engage with institutions, I think that helps this industry from more value into the ecosystem. So we ingest more capital. And then I think a lot of the, there's not all institutions are created equal. There's some that are moving hard and fast and trying to get into the tent now. And then some are going to wait and see approach. And to get more of those wait and seers, I think creating these platforms and these permission pools and really kind of hand-holding some of that is going to be a good use of time because it'll further pressure test all the things that we're doing. Again, my big question is, how do the permissioned and permissionless kind of ecosystems converge, collide, evolve over time? It's a high class problem, and it'll get figured out. But for now, we've got to essentially hermetically seal two different paths, which makes it harder for builders and the BD piece and the rest of it. There's a lot of friction, but it's a very worthwhile investment.
The way I think about the problem is just in the big picture, sort of the technology is just sort of develops like this, on some pretty straightforward path, and then every now and then we run into like these financial incentives that really like kick it off. So you really want to be in a position where, I think like before like the first DeFi token started coming out, where you tried Uniswap out for the first time, you were like, okay, this is amazing, there's something very cool about this, and you're just surprised that no one really figures it out, and you're just in your own bubble sort of, and no one cares. And then the financial incentive sort of kicks it off. And I think that was the same thing for Ethereum originally. The ICO really kicked off the interest. So it tends to be one of those things where there's a financial incentive that eventually like kicks it off really, but that's one that really takes advantage of like unlocks that you've had along the way that only people in the industry care about, up until like the point where everyone can start caring about them. So a lot of those are like the low-hanging fruit still to be had is scaling. And I think like Ethereum's move to proof of stake will be one of those things, like considered in hindsight, key management, and lots of interesting things around like having partially like a part of your keys custody with a centralized party, part of it yourself, like having interesting recovery options around there, so that the sort of next version of Celsius you can build in a way directly on the DeFi side. You can get the transparency and all the positive aspects, and you don't like have to compromise on the UX, which I think has been a big reason why people prefer like those types of services over like the direct DeFi integration ones. So like a jump in quality there. And I think once you get like a lot of these pieces together, maybe we again are in a situation where we feel like we have more technology than adoption and more like cool things than adoption, and then like via some financial incentive, we'll find a way to kickstart us again.
Yeah, I think both Mika and Matthew sort of covered everything. I think for me, from a building perspective, I'm just, regardless of the market conditions and where we are, just really excited to see what the builders come up with over the next 3, 6, 12, 18 months while we navigate this market, because I just like, that's the exciting thing. I think we haven't seen half the use cases yet, and I believe in the market that we have. And it's a time where builders put their heads down, they be innovative, they've got the time to think, be creative, and push out really interesting products. And that'll kickstart the next round of, be it DeFi Summer, or it might just be Web3 Summer, right? Like, there's a lot of interesting things being built in the social aspect. It'll be the like social to finance. And I think we'll see this like bridging of like a multitude of worlds, bringing social, bringing finance and bridging it. And then I think that's where it's going to get like really, really exciting to see where the space is going. I'll also just add, I also think there's going to be more challenges as well being faced. I'm almost certain that we'll see some regulatory direction coming towards these CeFi players as well as DeFi. I think they're going to come in quite aggressively as well. I think we've seen that today with the SEC, with all their recent ones. And I think it's coming in one way or another. And I think that's going to be like a path that all these, be it the DeFi protocols need to navigate, but as well as these CeFi companies will also need to figure out. And I think that'll be a challenge, but I think we'll find innovative solutions to solve them during this time as well, because it's going to be required.
Awesome. I appreciate, hearing all your answers and kind of the diversity between them as well. Is quite interesting, and I think a very good place to end this conversation. So with that, I just want to thank, all three of you guys for joining. And, hopefully, I look forward to kind of progressing some of these conversations as we see like more of these kind of primitives being built out. And we kind of see more examples of kind of success coming out of the next kind of couple months of heads down building. So thank you all for joining, and hopefully we can have you guys back soon.
Awesome. Thanks, George. Thanks, guys.
Yeah, thanks, everyone.
Thank you.
Thanks.